I'm Joseph, and this is Wise Life America. If you have a pension, the IRS treats you completely differently than every other retiree in America. Different from the person with a 401k, different from the person living on Social Security alone, different from the person with a brokerage account, and almost nobody, including most accountants, understands what that actually means for your tax bill. Here's what I want you to think about for a second. Only 14% of private sector workers still have access to a real pension. 86% of state and local government workers do. So if you are watching this video and you have a pension coming, you are in a very small, very specific group. The strategies that work for everybody else, the rules of thumb you read in retirement books, the 4% rule, the standard withdrawal sequence, almost none of it was written for you. I am going to walk you through 6 things the IRS does to pension holders that nobody is talking about. By the end of this video, you will understand exactly why your pension changes. The math on Social Security taxation, on Roth conversions, on Medicare premiums, on state taxes, on required minimum distributions, and on the lump sum versus monthly payment decision that almost everyone gets wrong. But before I get into it, I want to ask you something. Drop a comment right now and tell me one thing. Do you have a pension coming, or are you already collecting one? Just yes or no. The reason I'm asking is because the comments on this video are going to tell me which version of this content to make next. If most of you are still working and trying to plan, that is one video. If most of you are already collecting and trying to fix things, that is a different video. So just drop yes or no in the comments. 2 seconds. I read every single one. Before I go any further, I have to be clear. I'm not a lawyer. I'm not a CPA. I'm not a financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational examples based on current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. My name is Joseph, and if this is the first video of mine you're watching, this channel is for one specific group: retirees and pre-retirees over 60 who want to understand how the IRS actually works in retirement. Not the version you got from your HR department. Not the version your neighbor with the strong opinions told you. The real version with real numbers explained in plain English. If that sounds like you, hit subscribe right now, because what I am putting out next week is going to be one of the most important videos I have ever made on this channel. Now let us start with the thing that surprises pension holders the most. The first thing the IRS does differently is treat your pension as fully taxable ordinary income. Every single dollar of it in most cases. People do not realize this. They think because they paid into the pension during their working years, the money they receive will be at least partially tax-free coming back out. That is not how it works for the vast majority of pensions. If your pension was funded entirely by your employer with pre-tax contributions, every dollar you receive in retirement is taxable as ordinary income at your federal marginal tax rate. Not capital gains rates, not some special pension rate. Ordinary income the same way wages are taxed. If you contributed after-tax dollars to your pension, during your working years, you get a small portion back tax-free using something called the simplified method. But for most public sector pensions and most private pensions, the percentage of your benefit that is tax-free is small, often less than 10% of each payment. Here is what that means in practical terms. Say you are receiving $36,000 a year from your pension. If you assume that money is going to land in your bank account, untouched the way Social Security feels in your head, you are going to be wrong by a lot. At a 12% federal bracket, that is about $4,300 going to the IRS. At 22%, it is closer to $7,900. And that is before state taxes touch it. Which brings me to the second thing the IRS does differently. Your state of residence matters more for pension income than for any other type of retirement income. Most retirees think about state taxes mainly in terms of whether their state taxes Social Security. 9 states still do, but pension income is treated completely differently from Social Security at the state level. And the variation is enormous. Pennsylvania, for example, does not tax pension income at all. 0. If you receive a pension and you live in Pennsylvania, the state takes nothing. Illinois the same. Mississippi the same. New Hampshire, no income tax at all. Florida, Texas, Tennessee, Nevada, no income tax at all. Compare that to California, where pension income is taxed as ordinary income at the state's regular rate, which can hit 9.3% depending on your bracket. Or New York, where the first $20,000 of pension income is exempt for those over 59 and a half, but everything above that is fully taxed at the state level. Or Minnesota, which still taxes a significant portion of pension income with limited exemptions. If you have a pension of $40,000 per year and you live in California versus Pennsylvania, you are looking at roughly $3,700 per year in additional state tax just because of geography. Over a 25Y-year retirement, that is over $90,000. Same pension, same lifestyle, different state, $90,000. The third thing the IRS does differently with pension holders is it changes how much of your Social Security gets taxed compared to someone without a pension. This is the part almost nobody explains correctly. The IRS uses something called provisional income to determine how much of your Social Security benefit becomes taxable. Provisional income is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. If you are a single filer and your provisional income is below $25,000, none of your Social Security is taxed. If it is between $25,000 and $34,000, up to 50% of your benefits are taxable. Above $34,000, up to 85%. For married couples filing jointly, those thresholds are $32,000 and $44,000. Now, here is what nobody tells you. Pension income counts fully toward your provisional income. Every single dollar, there is no exemption. There is no offset. So if you have a pension of $30,000 per year, your provisional income starts at $30,000 before you have even withdrawn a penny from your IRA, before you have collected your Social Security, before you have earned any interest from a savings account. What that means is that pension holders are almost mathematically guaranteed to be in the 85% zone for Social Security taxation. If you have a $30,000 pension and you collect $24,000 in Social Security, your provisional income is $42,000 even with zero IRA withdrawals. You're well above the $34,000 threshold. 85% of your Social Security is taxable. That is $2,400 of additional taxable income just from your benefit alone. Compare that to someone with no pension who has the exact same $24,000 Social Security benefit and pulls $30,000 from their IRA. They have flexibility. They can pull less from the IRA in any given year. They can do strategic Roth conversions. They can manage their provisional income. You cannot. Your pension is going to pay you the same amount every month, whether you want it to or not. The thresholds were set in 1983 and 1993. They have never been adjusted for inflation. Pension holders cross them automatically. Quick break. I want you to drop another comment. Tell me, did you know your pension was pushing your Social Security into the 85% taxable zone? Yes or no? I am genuinely curious how many people watching this had no idea. The comment section is where I find out what to teach next, so please tell me. The fourth thing the IRS does differently is it changes the math on Roth conversions in ways that work for pension holders, not against them if you know how to use it. A Roth conversion is when you take money from a traditional IRA, pay tax on it now, and move it into a Roth IRA where it grows tax-free forever and never has required minimum distributions. For most retirees, the optimal time to do conversions is the gap years between retirement and age 73 when RMDs start. Those years are typically the lowest income years of retirement. But pension holders do not have those low-income gap years. The pension starts. The income is fixed. There is no low-income window to exploit. So conventional Roth conversion strategy says you missed the window. The pension is going to keep you in a higher bracket forever. So why would you convert at 22 or 24% when other retirees can convert at 12? Here's the counterintuitive truth. For pension holders, Roth conversions can still make tremendous sense, but the reasoning is different. The reason is not that you're converting at a low rate. The reason is that your pension already locked you into a high effective marginal rate forever, and the future is even worse. When you start taking required minimum distributions at 73, those RMDs stack on top of your pension. Your pension does not stop. Your Social Security does not stop. Your RMDs are calculated based on your traditional IRA balance, and they get larger every year as a percentage of the account. By age 80, you might be required to withdraw 7% of your IRA balance every year, whether you need it or not. By age 90, it is over 12%. If you have a pension of $30,000, Social Security of $24,000, and a traditional IRA worth $400,000, your RMDs at age 73 start at around $15,000. By age 80, with normal growth, they could be over $25,000. Add it all up and you are looking at $60,000 to $70,000 of fully taxable income every year. Much of it forced on you whether you want it or not. That is the trap. Pension holders need to think about Roth conversions not as a way to find low brackets, but as a way to drain the traditional IRA before the RMDs make the situation impossible. Converting $20,000 a year in your 60s at 22% is painful. But converting $40,000 a year in your 80s at the same rate while also paying taxes on a full pension and fully taxable Social Security is dramatically worse. The math favors paying the tax now while you still have control. The fifth thing the IRS does differently for pension holders is the way Medicare ARMA search charges hit you. MIA stands for Income-Related Monthly Adjustment Amount, and it is a Medicare search charge that applies when your income crosses certain thresholds. For a single filer in 2026, if your modified adjusted gross income 2 years ago was above $19,000, you pay a Medicare Part B search charge on top of the standard premium. For married couples filing jointly, the threshold is $218,000. The standard Part B premium in 2026 is $22.90 per month. With the first IRMA search charge, that jumps significantly. At higher tiers, premiums can exceed $600 per month per person. Here is why pension holders need to pay attention. Your pension is fixed income that you cannot turn off. It contributes to your modified adjusted gross income every year. If you also have a substantial 401k or IRA, and if you do a Roth conversion in any given year, the conversion gets added on top of your pension. And Social Security. It is incredibly easy for a pension holder doing a normal-sized Roth conversion to accidentally cross an IRMA threshold. The 2-year look back is what makes this dangerous. The IRS uses your income from 2 years ago to calculate today's Medicare premium. So a conversion you do in 2026 can spike your premiums in 2028 by hundreds or even thousands of dollars per year for 2 years. Pension holders need to plan conversions with one eye on the federal tax bracket and the other eye on the ARMA tier they are about to cross. Most accountants do not run this calculation. Most retirees do not even know it exists. If you're a married couple with combined income from a pension and Social Security at $190,000, and you're thinking about a $40,000 Roth conversion, you need to know that it could push you across the IRMA threshold and cost you an extra $2,000 to $3,000 per year in Medicare premiums for 2 consecutive years. That is real money on top of the conversion tax. The strategy might still make sense, but you need to know the full cost. Now, before I get to the 6th and biggest one, I want to do something. If you have made it this far in the video, you are exactly the kind of person this channel is built for. Hit the like button. It takes 1 second, and it tells YouTube to put this video in front of more pension holders who need to hear it. And if you have not subscribed yet, do it now. I make videos like this every week, and I do not want you to miss the next one. The 6th and biggest thing the IRS does differently for pension holders is the way your lump sum versus monthly pension decision affects your taxes for the rest of your life. When you retire from a job with a pension, you often have a choice. You can take a guaranteed monthly payment for the rest of your life, often with a survivor benefit option for your spouse, or you can take a lump sum, roll it into an IRA, and manage the money yourself. Most financial channels treat this as a math problem. What is the better return? Will you live long enough to break even on the monthly payment? But the IRS angle on this decision is rarely discussed, and it is enormous. If you take the monthly pension, every dollar you receive is fully taxable as ordinary income every year for as long as you live. That income is locked in. You cannot defer it. You cannot accelerate it. You cannot avoid it. It just keeps coming year after year fully taxable. If you take the lump sum and roll it into a traditional IRA, you have just bought yourself enormous tax flexibility. You decide when to withdraw, you decide how much, you decide what year to do a Roth conversion. You can manage your provisional income. You can stay below IRS thresholds in low spending years. You can accelerate withdrawals in years when you have higher deductions. You can do everything that pension holders cannot do because their income is fixed. But, and this is critical, the lump sum is only better if you actually use that flexibility. If you take the lump sum, roll it into an IRA, just take a regular monthly distributions exactly the way a pension would have paid you, you have given up the guaranteed income for nothing. You took on investment risk. You took on longevity risk. You took on the responsibility of managing the money. And you did not capture any of the tax flexibility that was the whole point. The lump sum decision is not really about returns. It is about whether you are going to actively manage the tax timing of every dollar for the rest of your life. If yes, the lump sum can be enormously valuable. If you are going to just leave it alone and pull a steady amount every month, the pension is almost certainly the better choice because it eliminates investment risk. It eliminates longevity risk, and the tax outcome is essentially the same as if you had taken the lump sum and not done anything strategic with it. There is also a hybrid option that almost nobody talks about. Some pensions allow a partial lump sum and a partial monthly payment. This is the option I would push almost every pension holder to seriously evaluate. Take part of the value as monthly income to cover your fixed expenses, the housing, the utilities, the food, the insurance. Take the rest as a lump sum to give yourself tax flexibility for everything else. You get the security of guaranteed income for your needs and the tax control for your wants. Most people do not even know this option exists. Ask your pension administrator. Now, let me bring all 6 things together because they all interact in ways that make pension planning fundamentally different from non-pension planning. Your pension is fully taxable as ordinary income, so federal taxes hit you harder than people realize. Your state of residence dramatically changes the after-tax value of your pension, in some cases by tens of thousands of dollars over retirement. Your pension automatically pushes your Social Security into the 85% taxable zone in most cases without exception. Your Roth conversion strategy is different because you do not have low-income gap years. But you also have a bigger RMD problem coming if you do nothing. Your Medicare RMA exposure is constant because your pension floors your income at a certain level forever, and any conversion stacks on top, and your lump sum versus monthly decision should be made primarily on whether you will actively manage the tax timing, not on rate of return assumptions. Here's the practical reality. If you are a pension holder, the standard retirement playbook does not fit you. The 4% rule was not written for someone with guaranteed income covering most of their expenses. The standard Roth conversion ladder was not designed for someone whose income floor is permanently elevated. The default Medicare premium calculator does not warn you about how easy it is to cross IMOA thresholds. The state tax comparison most people do focuses on Social Security, not pension income. You need a different framework, and the foundation of that framework is something professional financial planners call asset liability matching. Match your fixed expenses, the housing, the utilities, the food, the insurance, the basic transportation with your fixed guaranteed income, the pension, and Social Security. If your guaranteed income covers most of your fixed expenses, your investment portfolio is freed up to do other things. It does not need to be conservative. It does not need to throw off income. It can be invested for growth, for legacy, for opportunity, because your survival is already secured by the pension and Social Security. Let me give you a real example so you can see the framework in action. Imagine a couple, both 66. The husband retired from a state government job last year. His pension pays $36,000 a year joint and survivor. Their combined Social Security is $40,000 a year. Their fixed expenses, when they actually sat down and added them up, totaled $68,000 a year. Housing, utilities, food, insurance, basic transportation, healthcare premiums, that is it. So their guaranteed income is $76,000 and their fixed expenses are $68,000. They have $8,000 of cushion before they touch a single investment dollar. That changes everything. They have $450,000 in a traditional 401k that they had been keeping in a target date fund. 60% stocks, 40% bonds is the default, the conservative middle path that financial advisors recommend to everybody, but they do not need that money for survival. Their pension and Social Security cover their fixed life. The 401k is for travel, for gifts to grandchildren, for the occasional new car, for a buffer against a long-term care event. Those are wants, not needs, and money earmarked for wants. Can afford to take more risk because if the market drops 30%, they cancel a vacation. They do not lose their house. The right answer for them is probably to be more aggressive in the 401k, not more conservative. 80% stocks, 20% bonds, or something even more growth-oriented. Their pension is acting as the giant bond allocation in their overall picture. Adding more bonds to the 401k is double counting. It is leaving growth on the table for safety they already have. Now layer on the tax strategy. They are 66. They have 7 years until RMDs start at 73. During those 7 years, they should be doing strategic Roth conversions every single year. Not because they have low income gap years, they do not, but because their RMDs at age 73 on $450,000 compounded for 7 more years are going to be brutal. If that account grows to $700,000 by 73, the first RMD will be over $26,000 fully taxable on top of pension and Social Security. Converting $25,000 a year for 7 years at 22% cost them about $3,800 in cumulative federal tax over those 7 years. But it removes nearly $200,000 from the future RMD pile over a 30-year retirement. That math saves them well into 6 figures. The conversion is painful in year 1. It is invisible by year 10. It is a gift to themselves at age 85. This is the part most pension holders get wrong. They have guaranteed income covering their needs, and they still keep their 401k in conservative balanced funds, treating it like it is the safety net. It is not the safety net. The pension is the safety net. The 401k is the opportunity fund. Pension holders can often afford to be more aggressive with their investment portfolio than retirees without pensions because they are not relying on it for survival. There is one more piece of this puzzle that almost nobody gets right, and it has to do with your spouse. When you elected your pension, you probably had a choice between single life, which pays more per month but stops the day you die, and joint and survivor, which pays less per month but continues to your spouse for the rest of their life. Most people make this decision based on the monthly payment difference. They take the higher single life payment because it looks like the better deal on paper. Run the numbers on what happens to the surviving spouse. When one spouse dies, household expenses do not drop by half. They drop by maybe 20 to 25%. The mortgage is the same. The utilities are mostly the same. The insurance is mostly the same. But the household loses one Social Security check entirely. And if you elected single life pension, the entire pension stops too. So the surviving spouse is left with 75% of the previous expenses and often less than 50% of the previous guaranteed income. That is the gap that ruins people. I have seen widows in their late 70s who were financially comfortable when their husband was alive, and within 5 years of his death, they are pulling the entire shortfall from a 401k that was never sized for solo support. The decision to take single life pension to maximize monthly income while both spouses are alive is one of the most consequential financial mistakes pension holders make. And it is almost always made without modeling the survivor scenario. If you are married and you have not retired yet, model this. Take your fixed expenses, subtract 25%. That is your surviving spouse's expense floor. Now look at what guaranteed income would remain if you died first. Just the surviving Social Security check plus whatever pension survivor benefit you elected. If that number is well below the expense floor, the joint and survivor election is almost certainly the right choice. Even though the monthly payment is lower while you are both alive, you are buying insurance for the most vulnerable years of your spouse's life. There is also the inflation problem that pension holders need to take seriously. Most private sector pensions and many public sector pensions do not have a cost of living adjustment. The $36,000 a year you receive in year 1 is the same $36,000 in year 10, in year 20, and year 30, but the cost of everything around you keeps rising. At 3% annual inflation, $36,000 in today's purchasing power is worth roughly $27,000 in 10 years and $20,000 in 20 years. That erosion isn't visible at first. Year over year, you barely feel it, but by retirement, year 15 or 20, the gap between what your pension pays and what you actually need to maintain the same lifestyle is enormous. This is why the 401k or IRA balance is critical, even for people whose pension covers their current expenses. The investment portfolio is not just for wants. It is also for inflation defense, slowly bridging the widening gap between fixed pension income and rising real expenses. Social Security has a cost of living adjustment built in, but pensions usually do not. So the longer you live, the more your overall guaranteed income shifts away from being pension dominant to being Social Security dominant in real terms. Plan for that. Do not assume your 65-year-old budget works at age 80 without significant inflation-adjusted withdrawals from somewhere else. Once you understand that, every other decision changes. Roth conversions become a tool to drain the IRA before RMDs explode it. Strategic withdrawals become about managing her tiers, not about hitting a 4% rate. State residency becomes a serious financial decision because the math is different than for non-pension holders. The lump sum versus monthly decision becomes about whether you have the discipline and the help to manage tax timing, not about returns. Last thing before I let you go. If you have a pension, the most expensive mistake I see people make is doing nothing. They retire. They start taking the pension. They assume the IRS situation will sort itself out. And 10 years later, they are paying tens of thousands of dollars in taxes that could have been avoided with a few simple decisions made early. The IRS does not send you a letter explaining how much you are overpaying. They are perfectly happy to keep collecting. So here is what I want you to do. First, if you are still working, find out what choice you actually have for your pension. Single life, joint and survivor, lump sum, partial lump sum.